Our second partnership chapter, chapter 10, deals with distributions of various kinds. We're going to start with this video with non-liquidating distributions, and then in the next one we'll do liquidating distributions, and also in the second video a bit about the special basis adjustment. But first, non-liquidating distributions. General rule for distributions from a partnership are: no gain or loss is recognized by the partner or the partnership on distribution of property to a partner. The outside basis of the partnership interest must be reduced by the partnership's basis in the distributed asset, and the partner's basis in the property received is the partnership's basis. Those are the general rules. We are going to see exceptions to those general rules because of the other rule, which cannot be violated, which is that basis can never be negative. So distributions come in three categories. We have current draws against earnings, very much like a paycheck for being a partner in the partnership. Other non-liquidating distributions, we'll be talking about them as well in this video, and then liquidating distributions, which will be the next video. Current draws against earnings, almost always in cash, paid in regular intervals, often pro rata based on the partnership interest, and intended to cover partners' living expenses. So it's like a regular paycheck. We're going to treat current draws as if they all happen at the end of the tax year. First, adjust the basis of each partner's partnership interest for non-separately stated income, separately stated gains, and other income items, and contributions by the partners. Notice all three of those things increase basis. So we're going to adjust the basis for the increases first. Then reduce basis by the current draws for the year. Now remember, we don't want to recognize income, but after you've increased the basis of the partnership interest as much as you can, then when you subtract out the draws, if you get a negative number, recognize a capital gain, get that basis back up to zero. Then consider any loss items after your current draws. You can't deduct a loss if you have no basis. So once you have taken care of the current draws, and then if you have basis left, you can take your loss items. If you don't, then you're going to have to suspend those loss items. Other non-liquidating distributions. So they're not current draws. They're just other distributions that do not eliminate the partner's ownership interest in the partnership. They may be cash or other property. They may affect the partner's total interest in the partnership. So you could go from a 1/4 interest to a 1/5 interest because of a non-liquidating distribution. It's not always the case, but it could be. That could be part of the reason for your non-liquidating distribution. Just depends on what the intent of the partners is for that particular distribution. Does not reduce the partner's interest to zero. Now, it could reduce the partner's basis in the partnership interest to zero, but the partner's interest, the fraction of ownership that the partner has, is not zero. If it were zero, that would be a liquidating distribution. So this is non-liquidating. The partner is still a partner. Even if the basis in the partner's interest is zero, the partner is still a participating partner in the partnership. We're going to account for each distribution as it occurs during the year. Unlike the current draws, which we're going to pretend they all happened at the end of the year, here we're going to deal with them as they come during the year. Reduce the basis in the partnership interest by the amount of cash distributed. No room for wiggle room there because the basis of cash is always the amount of the cash. Those are the two immutable rules of basis, that no basis of any asset can be less than zero, and basis of cash is always the amount of the cash. So if you can't change those rules, then reduce the basis by the amount of the cash no matter what you get. But if cash exceeds basis, then recognize a capital gain to get that basis back up to zero. If you still have any basis left after the cash has been taken care of, then reduce the basis in the partnership interest by the partnership's basis of other property distributed. Reduce the basis of that other property if necessary, so that the basis of the partnership interest does not become negative. We're going to divide the distributed property into separate classes and consider them in this order. First of all, cash. You can't adjust the basis of cash, and so cash has to be considered first. Then most types of ordinary income property. We'll talk a little bit more about those in a bit. We call them hot assets, and they will be the subject of a large part of this video. And then other assets, things that do not qualify as hot assets, mostly capital assets and Section 1231 property. Within a particular class of property, apply the basis reduction first to assets with built-in losses in proportion to the built-in losses up to the amount of the built-in losses, so that you have essentially applied the basis reduction to those built-in losses until you get the assets with built-in losses down to their fair market value. Then all assets, so you've got the assets that had built-in losses and you've gotten rid of the built-in losses by reducing the basis of those assets down to their fair market value. Now take all of the assets, those with built-in gains and those that you now have at fair market value, in proportion to their remaining bases. Hot assets, assets of the partnership, which if sold for fair market value would result in ordinary income. They are cash basis accounts receivable, usually with a basis of 0. So if you sold them for fair market value, you would have income, and it would be ordinary income, just as it would be if you collect the account receivable. Inventory that is 120% or more appreciated. That's likely to be the case for LIFO inventory, but of course it could be true for any type of inventory. If you sell that inventory at a gain, which is of course what you hope to do with inventory, that's ordinary income. 1245 assets. Those are, to refresh your memory from Tax 1, 1245 assets are machinery, equipment, furniture, personalty placed in service in a business and depreciated, and the gain on the sale up to the depreciation that had been taken on those, that's depreciation recapture, and that gain is ordinary. So those are your hot assets. Cash basis receivables, appreciated inventory, and 1245 assets. The hot assets concept will also be seen to be relevant. We'll see it for partnership liquidations in the next video and sales of partnership interests, which we'll talk about also in the second video. But in that case, we're going to change the definition slightly. For liquidations, omit the 1245 assets, and for sales of interest, add all inventory, not just the 120% or more appreciated, as well as accrual basis accounts receivable. A lot of time, the basis of the accrual basis account receivable will be equal to the amount of the account. So there won't be much income recognized for that. But if there is any gain to be had from an accrual basis account receivable, you would also count that as a hot asset, but only in the case of a sale of interest. There's also a disguised sales rule. If a partner contributes an appreciated asset to a partnership, then the contributing partner will have to recognize that built-in gain if the partnership distributes that asset to another partner within 7 years. So essentially the rule is, hey, you were trying to sneak that asset over to the other partner, but not call it a sale. We're going to call it a sale. We're going to call it a disguised sale and make you recognize that built-in gain. So that's one way to do it. Or the other way would be if the partnership distributes a non-cash asset to the contributing partner within 7 years. Well, then the partner essentially traded its non-cash asset to the contributing partner in exchange for that appreciated asset of the partner. I'm going to call that a disguised sale too. But notice you can still give the partner cash. They don't want to prevent a contributing partner from getting their current distributions, for example. So it only applies to the distribution of a non-cash asset. Concept summary 10.2 on page 10.8 summarizes the rules for the proportionate current distributions. And note the word proportionate there. Disproportionate current distributions are also covered in the chapter, but are not part of concept summary 10.2. Here we are assuming that the distributions went to the partners, all of them, proportional to their ownership interest. We have a template for an Excel spreadsheet in concept summary 10.2 to show the effects of these proportionate current distributions. And here's the spreadsheet. Give you the details of the spreadsheet in the concept summary on page 10.8. This is the actual spreadsheet. It's a picture of the actual spreadsheet. I will also upload the spreadsheet itself into Brightspace so you can look at the spreadsheet. But it looks like this. We've got the 4 inputs, which I've done with the bold outlines in C2, 3, 4, and 5. And then the rest of it is all formulas. For the calculations 1 through 10, those are all formulas. And I also took a picture of the formulas, and there they are. So they're fairly simple formulas. A couple of mins and a max, and everything else is just equals, maybe some addition or subtraction, and that's it. So let's take a look at problem 1024. When Terry's outside basis in the TMF partnership is $80,000, the partnership distributes to her $30,000 in cash, an account receivable, fair market value of $60,000, inside basis of the partnership of 0, so a cash basis account receivable. Also a parcel of land, fair market value of $60,000, inside basis of the partnership of $80,000. Terry remains a partner in the partnership, and the distribution is proportionate to the partners. Use the format of Concept Summary 10.2 to create a spreadsheet to calculate the effects of the distribution. Here it is, right here. So this is just the same spreadsheet. We have the outside basis, they told us was $80,000. Cash and deemed cash distribution, $30,000. The partnership's basis in distributed hot assets, that was the account receivable, basis was 0. And then the partnership's basis in the other distributed property, that was $80,000. So calculations, the outside basis, we had $80,000. Cash distributed was $30,000. So no gain is going to be recognized by the partner because of the distribution of cash. There was plenty of basis left over, specifically $50,000 left over of basis after the cash distribution. Partnership's basis in the hot assets was 0. The partner's basis in those assets also 0. No reason to change that because the partner's remaining outside basis is still $50,000. And the partnership's basis in the other distributed property is $80,000. Well, you can't subtract $80,000 from the partner's remaining outside basis. So the partner's basis in that other distributed property is going to be only $50,000, even though the partnership's basis was $80,000. That reduces Terry's basis in her partnership interest to 0. Even though she's still a full participating partner, her basis has become 0 because of the distributions that she has taken. Letter B, based on the information in your spreadsheet, how much gain or loss will Terry recognize? No gain or loss is recognized. The only place you would recognize a gain would be in line 3, and she didn't. How much is Terry's basis in the land, accounts receivable, and the TMF partnership? Well, the land is $50,000. TMF partnership we saw was 0. That's line 10. And the basis in the account receivable is 0. That is line 6. How would your answer to part C change if instead the partnership's basis in the land was $10,000, fair market value was $30,000, and the cash and unrealized receivables distributions do not change? adjust the input section of your spreadsheet and explain your findings. Okay, so here's part D, new spreadsheet. Change in input is only the step 3, partnerships basis and other distributed property is $10,000 instead of the original $80,000. So the first few steps don't change. Cash was less than the partnership's beginning basis of $80,000, so no gain recognized. Remaining basis is $50,000. No change because of the receivables, because they have a basis of 0. So she's still at $50,000 after the receipt of the cash and the receivables. Then subtract the partnership's basis in the property, which is only $10,000 under this assumption, which means the partner's basis in that property will be the partnership's basis of $10,000, and Terry still has $40,000 remaining in the basis of her partnership interest. Problem 25, consider each of the following independent situations and answer the following questions. For each fact pattern, indicate, does the partner recognize gain or loss? Does the partnership recognize gain or loss? What is the partner's adjusted basis for the property distributed? And what is the partner's outside basis in the partnership after the distribution? By the way, I will explain later about why I'm calling it outside basis and why the textbook is calling it outside basis. We'll talk about the difference between inside and outside basis, but that will come later. In each case, assume the partnership owns no hot assets, so we don't have to worry about cash basis receivables, for example, or appreciated inventory. Show your calculations in the spreadsheet, and they give you the same instructions about the construction of the spreadsheet, which we've already done. So here is for situations 1, 2, 3, and 4. In situation 1, Kim received $20,000 cash in partial liquidation of her interest in the partnership. Her outside basis for the partnership interest immediately before the distribution is $3,000. So that's column 1 there. Column C, partner's outside basis before the distribution is $3,000. Cash is the only thing distributed, but that's $20,000, meaning Kim is going to have to recognize a $17,000 gain. And she can't let the basis of her partnership interest go negative, because no basis can be negative. Therefore, the only way out is to recognize a gain. So she recognizes a gain of $17,000. Number 2, Courtney receives $40,000 cash and land with an inside basis to the partnership of $30,000, value of $50,000, in partial liquidation of her interest. Courtney's outside basis for her partnership interest immediately before the distribution is $80,000. So we put $80,000 in the first input block. Cash is $40,000, and then the only other asset distributed is a not hot asset, the land, which is $30,000 with a value of $50,000. So Courtney's outside basis starts at $80,000. Cash distributed is $40,000, so that drops her remaining basis to $40,000. No hot assets distributed, so she's still at $40,000 in line 7. Then we have the partnership's basis in the other distributed property, which is $30,000. So Courtney will take that at the $30,000 partnership basis, leaving her with $10,000 remaining basis in her partnership interest. Number 3, assume the same facts as 2, except now Courtney's outside basis for her partnership interest is $60,000 rather than $80,000. So we'll just change the first item from 80 to 60. So now outside basis begins at 80. The cash does not wipe out that basis, so she still has remaining outside basis of 20 after the cash distribution. No hot assets distributed, so she's still at 20 after that, but now the partnership's basis in the other property is $30,000. She can't take it at $30,000, So she'll take it at $20,000, reduce the basis of her partnership interest to 0, and the basis in the land that she received, even though the partnership's basis was $30,000, hers will only be $20,000. Finally, number 4, Chloe receives $50,000 in cash and inventory with a basis of $30,000, fair market value of $50,000. In partial liquidation of her partnership interest. Her basis was $90,000 before the distribution. All partners received proportionate distribution. So Chloe's beginning basis is $90,000. The cash received is $50,000. And the inventory, which has a basis of $30,000, fair market value of $50,000. So that's more than a 20% increase. 20% increase would be $36,000. So $50,000 is way more than that. So we will call that inventory a hot asset. So $90,000 subtract the $50,000 in cash, and she's left with $40,000. Then subtract the hot asset at $30,000. That gives her a basis in the hot assets of $30,000 and a remaining outside basis of $10,000. No other property was distributed, so her ending basis is $10,000. Letter B. For fact patterns 1 through 4 in Part A above, are additional planning opportunities available to the partnership to maximize its inside basis and its assets? Well, we haven't talked about inside basis yet, so I'm going to skip Part B of this problem until we get to inside basis, and then we'll talk about the kinds of elections that the partnership can make to deal with differences between inside and outside basis. But we'll hold off on that for the second video. So we'll skip Part B of problem number 25. The tax law requires special treatment when a partnership holds hot assets, especially if the partnership receives a distribution with more or less than a proportionate share of the hot assets. In the problem 25 that we just did, there were hot assets distributed, but we were told that everything was proportionate. If it's proportionate, then it's not as much of a problem. But if it's disproportionate, then there can be an issue. Treat the distribution as if the partner received a proportionate share of the hot assets, and then exchange for the assets that they actually received. That deemed exchange will cause recognition of income by the recipient partner if they pretend swapped out some cash basis accounts receivable for some land, let's say. That would be essentially a realization of the accounts receivable and would cause the recipient partner to recognize income. If it went the other way and they got excess hot assets, then maybe the partnership is going to have to recognize gain or loss, because we'll pretend that the partnership traded some of its hot assets for the land that it hung on to and it maybe should have distributed it. So problem 28, we can see how that works. Vincent is a 50% partner in the TAV partnership. I'm assuming he's the V. He became a partner 3 years ago when he contributed land with a value of $60,000, basis of $30,000. Current value is $100,000. Tyler and Anita, that would be the T and the A in this partnership, each contributed $30,000 cash for a 25% interest. Vincent's basis in his partnership interest is currently $135,000. Other partners' bases are each $82,500, and the partnership holds the following assets. We have cash, basis and fair market value, both $200,000, as is always the case with cash, that the basis is equal to fair market value. Accounts receivable, basis is 0, so cash basis accounts receivable with a fair market value of $200,000. There's some marketable securities, basis of $70,000, fair market value $100,000, and then land with a basis of $30,000, fair market value of $100,000. So the marketable securities and land are not hot assets. The accounts receivable definitely is. In general terms, with no calculations, describe the tax results to the partners in the partnership of each of the following independent scenarios where the partnership distributes the assets indicated in a current non-liquidating distribution at the end of its tax year. So first, determine whether the distributions are proportionate. And obviously, sometimes they won't be. Letter A, TAV distributes $50,000 fair market value plot of land to Tyler and Anita and $100,000 of accounts receivable to Vincent. Well, that's disproportionate. Vincent just got a big load of hot assets, and Tyler and Anita didn't get any hot assets. The distributions are proportionate in the sense that they all received the proper amount of value relative to their partnership interest. That is, 250s for the 225% owners and $100,000 in value for the 50% owner, Vincent. But disproportionate in their composition of hot assets versus other assets. So we're going to treat as if Tyler and Anita each received a proportionate share of accounts receivable and then also a proportionate share of the land, which would be the total $50,000 each of them got would have been $25,000 each of receivables and $25,000 worth of land. Vincent would have received $50,000 of receivables and $50,000 of land. What he actually got was $100,000 of receivables. So we're going to pretend that he received that land and then swapped it with Tyler and Anita for their receivable. So Tyler and Anita gave up their receivables to Vincent for his land. Tyler and Anita each have $25,000 of ordinary income from the swap, the pretend swap of their receivables for the land. Vincent now has a basis in those receivables of $50,000. He's going to have to recognize a $30,000 built-in gain on the land, however, because that is under the disguised sale rule. That is the transfer of land less than 7 years from the time he contributed the land, and it was appreciated property when he contributed it. He contributed the land 3 years ago when he became a partner, and at that time, the basis was $30,000 and the fair market value was $60,000. So there's his built-in gain of $30,000. So he's going to have to recognize that built-in gain under the disguised sale rule. So they all have gains they have to recognize as a result of this transaction. Number 2, TAV distributes $100,000 of cash to Vincent, $50,000 fair market value of marketable securities to Tyler, $50,000 fair market value of accounts receivable to Anita. Well, now, Tyler and Anita, we're going to have to pretend they got $12,500 of those accounts receivable that all actually went to Anita. And then Vincent received $25,000 of receivables. Then Tyler and Vincent exchanged their receivables for cash and securities. So we know the value of the cash and the securities. It's going to be the value of the receivables. So Tyler and Vincent each have ordinary income equal to, in Vincent's case, $25,000, and in Tyler's case, $12,500. Number 3, TAV distributes $50,000 fair market value plot of land and $50,000 fair market value of accounts receivable to Vincent, $25,000 cash and $25,000 of accounts receivable each to Anita and Tyler. That's a proportionate distribution. Everybody got their proportionate share of the hot asset, 25, 25, and 50. So therefore, it's a proportionate distribution. Nobody has to recognize any gains. Letter B, now consider what would happen if the partnership distributed all its assets in a liquidating distribution. In deciding the allocation of assets, what issues should the partnership consider? Well, I think it's fairly obvious. The one thing that they definitely should consider is distribute your hot assets proportionally. You're not going to trigger the kinds of gains that you would otherwise trigger. So stay away from disproportionate distribution. If you're distributing all of the partnership's assets, liquidating the partnership, why not do it proportionally and let people recognize their gains on their schedule rather than just because they have to. Number 33. I'm going to skip a couple here. We're going to skip 30 and 32. We'll come back to them in the second video, but let's go straight to 33 now. In 2020, Adriana contributed land with a basis of $16,000, fair market value of $25,000 to the A&I partnership in exchange for a 25% interest in capital and profits. 2024, the partnership distributes this property to Isabel. So 4 years later, the property went from Adriana to Isabel. Also a 25% partner in a current distribution. So this is the A&I partnership. Adriana is a 25% partner, and Isabel is a 25% partner. We don't know who the other partner is. Probably an A or an I. Anyway, the fair market value of the land had increased to $30,000 at the time the property was distributed. Isabel's and Adriana's basis in their partnership interests were each $40,000 at the time of the distribution. So how much gain or loss, if any, does Adriana recognize on the distribution to Isabel? And what is Adriana's basis in her partnership interest following the distribution? Adriana is going to have to recognize her $9,000 built-in gain. The land had a basis of $16,000, fair market value of $25,000 when she contributed it. So there's your $9,000 built-in gain. Her basis in the partnership interest will increase from $40,000 to $49,000 because of that recognition of gain. Letter B, what is Isabel's basis in the land she received in the distribution? Her basis is the $16,000 partnership basis plus the $9,000 gain recognized by Adriana, total of $25,000. Letter C, how much gain or loss, if any, does Isabel recognize on the distribution, and what is Isabel's basis in her partnership interest following the distribution? No gain or loss recognized. Adriana recognized the built-in gain. Her basis in the partnership interest is $40,000 minus $25,000 because she took that land at $25,000, so she's at $15,000 now. How much gain or loss would Isabel recognize if she later sells the land for its $30,000 fair market value? Gain is $30,000 minus her $25,000 basis, or $5,000. They say, is that result equitable? Adriana is taxed on the pre-contribution gain. Isabel is taxed on the post-contribution gain. So that seems fair. It was Adriana's gain, after all. It's really not fair for her to pass that on to Isabel. And letter E, how would your answers in part A and B change if Adriana originally contributed the property to the partnership in 2012? And then 12 years later, the partnership distributes the land. Well, now the disguised sale rule does not apply. Adriana recognizes no gain. Isabel's basis in the land is $16,000. So Adriana makes out on that deal. Isabel, not so much. And that is it for our first video, primarily dealing with non-liquidating distributions. We will cover liquidating distributions and that special inside basis adjustment in the next video.